Hello, fellow investors. Welcome back to the channel. Today, we're talking dividend stocks, and if you stick around to the end of the video, I'll give you my personal top picks for dividend stocks. So, what exactly are we going to be talking about today? In this short video, we're going to become a dividend investing pro. Whether you're new to investing or looking to fine-tune your strategy, get ready to unravel the mysteries behind dividend stocks. As a bit of a rule on the channel, I like to make sure all my videos have a little something for veteran investors to consider and plenty of stuff for new investors too. Now, let's get your money working for you. If you're excited to learn or just a fan of dividend stocks, hit that thumbs up and let's get started. Understanding dividend stocks. Firstly, what is a dividend stock? If you already know this and you want to just skip ahead to the good stuff, feel free to skip ahead about 30 seconds. So let's get on the same page about what a dividend stock actually is. Think of them as companies that want to share their success with you, the investor. I'll give you kind of the almost dictionary definition of what they are. Okay, so I wrote down this next bit, so if it sounds like I'm reading off my notes, that's because I am. A dividend stock refers to a type of publicly traded company's stock that pays out a portion of its earnings to its shareholders in the form of dividends. Dividends are typically paid out on a regular basis, such as quarterly, semi-annually, or annually. When buying a dividend stock, it really is important that you check this. You need to know if you're getting that payment, twice a year, 4 times a year, or just once a year. Like, check this always, okay? These payments are often considered a way for shareholders to receive a share of the company's profits directly. When a company generates profits, it has several options on how to use these profits. The options are to basically reinvest for expansion of the business, research and development, or other initiatives. Another option is to distribute a portion of the profits to its shareholders as dividends. Dividend stocks are companies that have chosen to follow the latter approach. This is of course a way to make the stock more attractive to investors. Investors who hold these shares of dividend stocks receive a portion of the company's earnings in the form of dividend payments. The amount of dividend payment is usually determined by the company's board of directors and is typically based on factors such as company's financial performance, profitability, and overall strategy. Dividend stocks are often favored by investors seeking a regular and relatively stable source of income from their investments. This can be particularly attractive to retirees looking for some additional income, some capital appreciation, or for anyone with a mortgage, really. Like, if you can get to the point where your dividend income is paying a good chunk of your mortgage, you're doing pretty well. An important note here is that in general, dividend yields between 2 and 4% are considered pretty strong. Anything above 4%, it can look like a great buy, but it's also probably a risky one. So, like, they're offering you a higher percentage, a higher return, because it's actually a slightly higher risk stock. So when comparing these stocks, it's important to look at more than just the dividend yield. The benefits of dividend investing. In this segment, we'll break down dividends, their importance, and how they can turbocharge your financial growth. Why choose dividend stocks, you ask? So here's the incredible perks of dividend investing. Building passive income streams to enjoying tax advantages, and if you plan to hold them in the long term, the value of the stock rises faster than inflation, then you're going to be well in profit because you're getting a bit of growth and your dividend, right? So the main reasons why dividend stocks are the smart choice for long-term wealth is a combination of these factors. Okay, 30-second crash course time. For simplicity's sake, let's say you put $1,000 into a dividend stock. Now let's say that stock pays you 4%. It does this 2 times a year. So after year 1, you've been paid out $80, and you still have the original 1K stock. Let's say that stock goes up 5% in a year. At the end of year 1, you were paid out your $80 in dividends. Stock value climbed from 1,000 to 1,050. Then in year 2, you'll be paid 4% of 1,050 2 times a year, which is $82 payout. So you can see this is compounding growth. This is compounding growth while you're getting a percentage-based income, which is a pretty good proposition. Isn't that right, Chi? So let's roll up our sleeves and dive into the actual mechanics of dividends. I'll walk you through dividend dates, dividend yields, and dividend payout ratios. You'll learn how to read dividend announcements like a pro and understand what these metrics reveal about a company's financial health. Dividend dates refer to important dates in the process of distributing dividends to the shareholders of a company's stock. There are typically four key dates. Okay, so one is declaration date. This is the date when a company's board of directors officially declares the upcoming dividend. They announce the amount and the date of the dividend payment. Ex-dividend date, or ex-div as some people call it. The ex-dividend date is the cut-off date set by the stock exchange. If you buy shares before this date, you are entitled to upcoming dividends. If you buy on or after this date, you won't be receiving that dividend. The stock's price often adjusts downwards by roughly the amount of the dividend on the ex-dividend date. This is people selling their shares, people who bought the share just to grab the dividend and then get out of town, so to speak. Next important date is the record date. This is the date on which the company reviews its list of shareholders to determine who is eligible to receive the dividend. If you own shares on the record date, you're eligible to receive the dividend, even if you sell the shares after this date. And most importantly, payment date. This is the obvious one. It's the date on which the actual dividend payments are made to eligible shareholders. Dividend yield is a financial ratio that measures the annual dividend income that you as an investor can expect to receive from your investment. It's expressed as a percentage of the investment's current market value. Its calculations are as follow. It's worth bearing in mind a higher dividend yield generally indicates a higher income potential from the investment, obviously. However, it's important that you remember that a very high dividend yield can also be a sign of financial distress or instability in the company. So if you see dividend yields of like 6, 8, or even more percent, there are some out there with like 12%. You got to think to yourself, is the juice worth the squeeze? Sometimes these stocks can have an amazing yield as a kind of way to bait you in. It's the old saying, too good to be true. Think about that and assess it for yourself. But generally, anything over 4%, question it. The dividend payout ratio is a measure that indicates the proportion of a company's earnings that are paid out to its shareholders in the form of dividends. It's calculated as... This ratio gives investors insight into how much of a company's earnings are being distributed as dividends. A lower ratio suggests that the company is retaining more earnings for reinvestment, while a higher ratio indicates a larger portion of its earnings are being returned to shareholders as dividends. It's worth noting that excessively high payout ratios might indicate that a company is not reinvesting enough and its operations of future growth are therefore limited. Conversely, a very low ratio might suggest that the company is being overly conservative with dividend payments. So, just like with most things in stocks, it's all about finding the balance. In conclusion, understanding dividend dates, dividend yields, and dividend payout ratios can help investors make informed decisions about investing in dividend-paying stocks. These concepts provide insights into the financial health of a company and the potential returns an investor might expect from their investment in the future. Okay, let's get into the good stuff. Strategies for selecting dividend stocks. Now that you're armed with dividend knowledge, it's time to become a dividend detective. I'll guide you through some effective strategies for selecting the right dividend stocks for you. We'll discuss factors such as company stability, dividend history, and the importance of diversification within your portfolio. Firstly, dividend yield. Look for stocks with reasonable dividend yields. This is calculated by dividing the annual dividend per share by the stock's current price. So that's how you get the percentage, obviously. A higher yield can provide more income, but be cautious of extremely high yields as they could indicate financial instability, as I've said already, but I'm really trying to draw that point home. So the next one is dividend growth. Consider stocks that have a history of consistent dividend growth. Companies that are regularly increasing their dividends often demonstrate financial strength and a commitment to rewarding their shareholders. Dividend payout ratio. Evaluate the dividend payout ratio, which is the percentage of earnings paid as the dividend. A sustainable ratio indicates that the company can comfortably cover its dividend payments from its earnings. Dividend history. Review a company's dividend payment history. Look for companies that have had a long track record of paying dividends, especially during economic downturns. This is basically them sticking to their word and not being too fussed about the market having a wobble. Financial health. Assess the company's overall financial health, including its debt levels, cash flow, and profitability. A financially healthy company is more likely to maintain its dividend payouts. There's some great websites out there for analyzing stocks. I'm actually going to do a video about that in the future. They basically do all the analysis for you. You just kind of read and digest the data. But once you look into the financial health of a company and compare it to its dividend, you'll understand whether it's healthy or not, basically. Next, industry stability. Consider industries that are known for stability and consistent cash flows. Companies in sectors like utilities, consumer staples, healthcare tend to be more reliable dividend payments. Competitive advantage. Look for companies with a strong competitive advantage or a unique market position. A solid competitive position can contribute to steady earnings and dividend growth. Earnings growth. Companies with a history of consistent earnings growth are often better positioned to sustain and increase their dividend payments. Market cap. Larger, more well-established companies often have more stable dividend policies. Small companies may offer higher growth potential, but could be riskier in terms of the dividend stability. Management and leadership. Assess the quality of the company's management team. Strong leadership can lead to better financial decisions and overall company performance. Especially companies like Tesla and Facebook, where their CEOs are kind of celebrities in their own right at this point. This can almost add to the value of the company, although this can be a double-edged sword. If they do or say something stupid, it could obviously affect the reputation of the company, therefore the stock. Next, economic conditions. Consider how the company's performance may be affected by different economic scenarios. Some companies are more resilient during economic downturns, making their dividends more dependable. For example, just look at COVID. Companies like Netflix, the stay-at-home stocks did really well. Companies that are based on people, going in person to their, let's say cinemas, going in person to their place of business to actually spend the money, they suffer. So with all stocks, you've got to assess the current market conditions. International exposure. Diversifying your dividend portfolio across international markets can provide exposure to different economic conditions and potential enhancements in overall stability. It's all about spreading the risk. Reinvestment opportunities. Evaluate whether the company is reinvesting in their growth. Companies that strike a balance between dividend payments and reinvestment in the business can often offer long-term benefits. It's always good to have a dividend stock that is also growing, basically. Research and analysis. Conduct thorough research and analysis of potential dividend stocks. Understand the company's products, services, competitive landscape, and potential risks. Obviously, you've got to know who you're invested in. This is your hard-earned money. Always dig into a company a little bit. Do a bit of research. Long-term perspective. Dividend investing is often most effective when approached with a long-term perspective. Regular dividend income and potential capital appreciations can compound over time, especially when and if you choose to reinvest your dividends into the stock. Even the best investors make mistakes, but let's try to help you sidestep the most common ones. Let's cover the pitfalls like chasing high yields, ignoring diversification, and not staying up to date on company developments. By knowing these blunders, you're one step closer to a successful dividend investment journey. When buying dividend stocks, there are several common mistakes that investors should avoid in order to make informed and successful investment decisions. Here are some of the most common mistakes. Chasing high yields without doing your research. Obviously, this can lead to pitfalls. Whilst high dividend yields can be attractive, it's important to research the underlying company thoroughly. Extremely high yields can sometimes be a red flag. Okay. Ignoring fundamental analysis. Don't solely focus on the yield. It's crucial to assess the company's financial health. Neglect dividend sustainability. Company's ability to sustain and grow its dividend payment over time is vital. Look for a consistent track record of dividends. Ignoring sector and industry trends. Different industries and sectors have varying levels of stability and growth potential. So you've got to be aware of how economic cycles and industry trends can impact your dividend income. Failing to diversify, relying too heavily on a single dividend stock or even a single sector can expose you to undue risk, obviously. Short-term thinking, dividend investing is often a long-term strategy, so don't be swayed by the short-term market fluctuations or minor changes in dividend payments. Market timing mistakes, trying to time the market by buying dividend stocks at the absolute lowest price can lead to a missed opportunity, of course. So focus on the company's fundamentals rather than trying to perfectly time your entry. There's an old saying, time spent in the market is much more important than trying to time the market. What else? Ignoring global economic factors. Dividend stocks can be affected, of course, by global economic factors, geopolitical events, macroeconomic trends. So consider the broader economic landscape when making investment decisions. In summary, successful dividend stocks investing requires thorough research, a focus on fundamental analysis, a long-term perspective, and a commitment to diversification. So avoiding these common mistakes can help you build a dividend portfolio that provides steady income and potential for growth over the long term. Your action plan. Okay, so you've absorbed a ton of information, so let's wrap things up with a solid plan. We've laid out a step-by-step guidance on how to start your dividend investment journey, so you'll have a roadmap to turn your knowledge into action. Investing in dividend stocks requires a well thought out action plan to ensure that you make informed decisions and gradually build a portfolio that aligns with your financial goals. So here's a step-by-step action plan to help you get started. Set clear investment goals. Define your investment objectives. Are you looking for steady income, capital growth, a combination of both? Your goals will guide you and your stock selection and therefore help shape your portfolio and strategy over time. Assess your risk tolerance. Determine how much risk you're comfortable with. Dividend stocks can offer a lot of stability, but they're still subject to market fluctuations, of course. Understanding your risk tolerance will help you choose appropriate stocks and allocate funds. Establishing a budget. Now, obviously, this is an extremely important one. Determine how much capital you're willing to invest in dividend stocks. Don't overextend yourself. This budget should be separate from your emergency funds and other essential expenses. Consider dividend aristocrats. So consider including some dividend aristocrats, as I call them, or companies with a long history of consistently increasing dividends, or at least consistently having a healthy dividend. These firms often have strong financials and a commitment to returning to shareholders. Create an investment plan. Develop a detailed investment plan, whether you do it on notes on your laptop or on paper, it doesn't matter. Develop a detailed plan and outline your stock selection criteria, allocation strategy, buying and selling rules. This plan will keep you disciplined and focused. Invest regularly. Implement a systematic investment approach. Invest in a consistent amount of money at irregular intervals, e.g. monthly or quarterly, to take advantage of dollar cost averaging. It's a really good strategy. It's proven over time, and it's just a really good way to do things. Reinvest dividends. Consider reinvesting dividends to compound your returns over time. Many brokerage platforms actually offer dividend reinvestment programs, or drips as they call them. This automatically invests dividends into additional shares. It's not a bad option. Some people like to have the money, some people like to reinvest it, but it's good to have the option. Review and adjust. Regularly review your portfolio's performance and make necessary adjustments. Keep up with company news, industry trends, and changes in investment goals. It's really good to give yourself like a little health check every quarter or every 6 months on your portfolio, just to see what's working, what's not. Stay disciplined. Stick to your investment plan and avoid making emotional decisions based on short-term market fluctuations. This is probably the best advice anyone who's worked in the financial market can give you. Avoid emotional decisions. It's not going to help you in the long term to make money. Now, as promised, here are my current top picks for dividend stocks. Remember, I'm not here to give you financial advice. I'm certainly not here to push anyone to buy any particular type of shares. As always, I really encourage people to do their own research before picking any stock or anything else to invest in. I'm here to educate you guys on the markets and hopefully have a bit of fun with it. But here are my personal top picks at the moment for dividend stocks. So, number 1, Games Workshop. Games Workshops is in the industry of toys and gaming. It's got a dividend yield of 4.1%, but it's actually a growth stock, in my opinion. It's definitely had a lot of growth in the kind of last 5 to 7 years. It's a really healthy, strong stock. It's got a lot going on, and this company's earnings just keep going from strength to strength. They're also the giant of their little industry, so they kind of make models and figurines and stuff. And they have like a board gaming system and some video games. So they are the kind of giant in their industry by quite a large margin. So it gives them a kind of monopoly. And as I say, it's got a healthy dividend whilst being a growth stock. So I think it's a really good pick. Number two, Verizon Communications. So the industry they're in is telecom services, in case you couldn't guess by the name. Their dividend yield is just over 7%, which is pretty high. And I know I even said earlier in the video, always question these high yields, but Verizon Communications, they've obviously been around a long time. They've got a pretty strong balance sheet. They're very high up in the index they're in. They're a solid company. So yeah, just take the win with this one. Just take the high dividend for the win here, I think. Number three, Comcast. Industry, telecom services again. Dividend yield is 2.78% on this one. Comcast stock is, at the time of recording, trading below its fair value, and the company's second quarter results were better than expected. So, decent dividend, under fair value, which is always something to look for in a stock. And there you have it, ladies and gentlemen, your crash course in dividend stocks. Remember, building a dividend portfolio takes time and patience, but the rewards are absolutely worth it. If you found this video helpful, don't forget to subscribe and ring that notification bell for more financial insight. Until next time, keep learning, keep growing, keep investing in your own financial future. Bye for now.